Hello, I am Adrian Cronier, the CEO and CIO of Ballantine. And over the next few minutes, I'd like to spend some time bringing you up to date with the latest thinking from our investment team on portfolio positioning as well as the capital markets. You can see the detail behind our discussion in our quarterly letter, which we entitled, Do the Roaring Twenties Beckon Again? So after closing the chapter on a harrowing 2020, it almost seems naive to be asking such an optimistic question again. However, if history does not always repeat itself, it often rhymes, and there are faint echoes today of what occurred in the 1920s, ultimately setting up a decade of robust economic growth, widespread prosperity, and investment opportunity. We will get to this comparison in greater detail in our outlook, but we begin by reviewing last year and exploring the investment themes from which our strategies should benefit in the coming months. Let's start by reviewing the great coronavirus crash of 2020. Stock markets rallied sharply after the conclusion of the presidential election to post one of the best quarters in a decade, putting a capstone on a tumultuous year. After falling more than 30% from peak to trough last spring, US stocks as measured by the S&P 500 returned a remarkable 18% during the 2020 calendar year, while bonds returned a mere 8%. Remarkably, growth stocks gained 38%. So by any measure, the opportunity set for investors was rich last year. Yet, for many, it was an extraordinarily difficult year, as 2020 featured a sequence of seismic events, making it easy to succumb to emotions of fear and anxiety and submit to the temptation to time the markets rather than staying the course. The challenges included a global health pandemic, a sharp and severe recession, unemployment which peaked at levels not seen since the Great Depression, oil prices which briefly traded negatively as energy demand collapsed, social unrest, a highly contentious election cycle in the United States, and further afield, the United Kingdom finally consummating a Brexit deal to leave the European Union more than 4 years after voting to do so. Despite these headwinds, our strategies fared well, materially outperforming their benchmarks. Last year amplified a trend which started 3 years ago, featuring capital markets with much more normal levels of volatility and asset class dispersion, allowing the benefits of our diversified approach to become especially clear. When compared to a peer group universe of more than 200 investment firms, the public market components, so those are the stocks and bonds that we invest in, the public market components of our strategies consistently now rank within the top quartile, and in many instances, the top decile over any time frame longer than a year over the last decade. In building this consistent long-term track record, we recognize there were periods over the short term, such as several quarters, during which our results were out of lockstep with the broader market, which serves as a reminder of the inevitability of it happening again, as well as the need for patience when it does. We will not rest on our laurels and will continue to work hard every day to refine and hone our process in pursuit of excellence. In 2020, our results were driven by two key factors. Firstly, we remained fully invested throughout the year, emphasizing stocks over bonds, even as markets crashed in the first quarter. Our model signaled we were not entering a sustained bear market because stock markets never became extremely overvalued compared to bonds, and we listened to that signal. Secondly, our process led us to tilt our exposure to winning areas, such as US large cap growth stocks and gold, and away from underperforming areas such as value and international stocks. Not since 1999 has the spread in returns between growth and value stocks been as wide, with investors seeking resiliency from stocks with sound balance sheets and an uninterrupted recurring revenue business model during an economic lockdown. I would like to call out 3 enduring investment lessons from last year as well. We think last year underscored the importance of 3 key hallmarks of our approach. First, as we have discussed in previous quarterly letters, cash is an asset class. Our discipline starts with always maintaining 2 years' worth of spending needs net of portfolio yield in cash and cash equivalents, which prevented us from having to sell stocks at artificially depressed prices in March and April, thereby leading to the potential for permanent impairment of capital. This discipline may seem pedestrian during a long, calm bull market, but it is a key source of resiliency during unexpected duress. Secondly, our decisions were driven by our unemotional, model-driven approach. As a reminder, we use objective, quantitative measures of both relative value and momentum to guide our decisions. And this insulates our decision-making from subjective and emotional assessments while giving us confidence our past track record will be repeatable in the future. Crucially, we use momentum to objectively confirm whether relatively cheap asset classes are indeed a mispriced opportunity, or whether relatively expensive asset classes should be sold. Cheap sectors can become cheaper and spend years out of favor before investors reward them again, as anyone who has invested in value and international stocks over the last decade will realize. This balance between relative value and momentum is what drives the consistency of the track record we have developed, as I described a moment ago. And thirdly, doing nothing is an active decision. During volatile years such as 2020, there is often a powerful impulse to act and to make decisions impatiently, when sometimes the best course of action is to stay above the noise by maintaining existing positions, as uncomfortable as it may feel at the time. Note that this is very different from simply lazily staying the course and riding out episodes of volatility. Our process is geared towards reducing risk when it objectively confirms a significant and extended stock market bear market lies ahead, because markets have become extremely overpriced relative to bonds and future interest rates. It also looks through the inevitable corrections of 10 to 15% along the way, or infrequent crashes when prices drop precipitously. Those typically resolve themselves quickly if underlying overvaluation conditions do not exist. There were many other enduring lessons learned by investors during 2020, on which we expound in greater detail in Ballantyne's Investing Cardinals, along with helpful resources and suggested readings available by request on our website at ballantyne.com. Let's now turn to our investment themes and strategy positioning across public and private markets as we start 2021. As we begin this year, our models are cueing off several major investment themes which are influencing our outlook. Firstly, they are cueing off of the progress that is being made in distributing and adopting the vaccine. Scientists and epidemiologists achieved an historical accomplishment by developing and testing vaccines for a novel virus, COVID-19, which was approved at warp speed last year, in under 1/10 the time it usually takes to do so. Attention in the markets has now shifted to how quickly vaccines can be distributed and adopted by populations here and abroad. This logistical challenge may be greater than the development of the vaccine itself. Progress is key to opening up several areas in the services sector, which remain stranded in more targeted lockdowns as the virus has surged again during the winter months. The second investment theme that our models are cueing off of is the potential for further, larger than anticipated government spending. In early January, the Georgia Senate runoff elections delivered control of the Senate to the Democratic Party, reinforcing its ability to advance its economic agenda with control over both houses of Congress and the presidency. Unlike the global financial crisis of 2008 and 2009, there are no longer debates about the need for fiscal austerity or fiscal stimulus. In fact, Congress has already passed 5 rounds of fiscal stimulus in bipartisan fashion over the past year, amounting to nearly 18% of GDP. With unemployment remaining elevated at 6.7% and increasing signs of permanent job losses in certain idle sectors, the Democrats are likely to push for more spending on unemployment benefits and infrastructure, areas in which they have common ground with Republicans, quite literally to build a bridge for the unemployed to a post-pandemic economy. In the short term, the size of the stimulus is likely to be larger and happen more quickly than what markets were anticipating in November. when government looked a lot more gridlocked in the immediate aftermath of the elections. Over the longer term, once the pandemic subsides, how we pay for the exorbitant privilege of being able to finance deficits of this magnitude will become the central investment issue of the early part of this decade. With government debt expected to exceed GDP, Congress will need to broaden the tax base and address reform of the entitlement programs. Key questions will center on how much inflation will rise and how far the price of the US dollar will fall to rebalance our debt to GDP ratio to a more sustainable trajectory. The coming years of rising taxes will therefore place a premium on after-tax returns and proactive financial planning. The third theme that our models are queuing off of is a prolonged period of easy money and low short-term interest rates. Here, the Federal Reserve has signaled clearly it is not worried at all about inflation in the near term. In fact, it is committed to allowing the economy to run hot by tolerating a period of above-average inflation to hit its target of 2% on average after a decade of persistently falling short of it. This means short-term rates are likely to remain near zero well beyond this year, even if the Federal Reserve slows the rate at which it has been purchasing assets to support a wide range of capital markets. The Fed's balance sheet has ballooned by an eye-popping 70% since the pandemic began, with its efforts to provide liquidity and ensure a smooth functioning of fixed income markets. All this monetary stimulus has translated to the money supply growing at an annual rate of around 20% over the past 9 months. As a result, inflation expectations are on the rise, as are long-term interest rates, steepening the yield curve and putting downward pressure on the US dollar, which has declined by more than 10% since its peak in March last year. The fourth investment theme is a burst of technological innovation which is serving to boost productivity growth and corporate earnings. As we have discussed in detail during the past few months, the tech acceleration unleashed in 2020 is a positive tailwind for corporate profits. The pandemic has forced many companies to adopt game-changing technologies more quickly than otherwise, which will allow them to do more with less. Examples include virtual communication, automation of manufacturing, digitization of payments, and also artificial intelligence. This will help to contain incipient inflation pressure over the longer term as the economic recovery continues. In the near term, estimates of corporate earnings, which were expected to grow by 20% for the S&P 500 in 2021, may be ratcheted up even further as additional fiscal stimulus arrives early in the year. Forward 12-month earning expectations for the S&P 500 are now already in excess of year-end 2019 levels. Corporate earnings growth is expected to be even higher in international emerging markets. So to summarize, in 2021, the combination of the benefits of a broadly adopted vaccine and continued stimulus will lead to a robust economic recovery, which will accelerate during the second half of the year as pent-up demand for services in lockdown is unleashed. Inflation may start to rise, but it is unlikely to reach problematical levels for the Federal Reserve to remove the punch bowl from the party anytime soon. Let's dive in greater detail into our positioning in public market components of our strategies. With higher corporate earnings expectations and a steeper yield curve, stocks are now modestly inexpensive relative to bonds and interest rate expectations. Coupled with positive relative momentum, we remain near the top end of our ranges in stocks and the bottom end of our strategies ranges in fixed income. We continue to recommend averaging in significant new cash to portfolios over a period of 6 months, reserving the right to accelerate that schedule if the stock market corrects. The post-election market rally was propelled by broad participation across many areas. This is indeed a healthy sign, which often confirms a sustainable bull market. Many of the distressed cyclical and value-oriented areas of the economy, which had been left behind by the recovery from the March lows, have rallied as markets anticipated the arrival and distribution of an effective vaccine. International markets, given the tailwinds of a declining dollar and a global economic recovery driven by an early return to normal from manufacturing, have also begun to outperform, especially in the emerging economies. Though our models suggest it is still too early to confirm the long-awaited rotation away from growth to value stocks, they did call for two changes to positioning within our global equity allocations over the last quarter. First, relative momentum confirmed we should increase our allocation to emerging market stocks. Key factors in this shift include the low price of emerging market stocks relative to their own histories and to the US after years of underperformance, the manufacturing-based focus of their economies, which may be less vulnerable to further pandemic restrictions, and a potential tailwind resulting from a period of further dollar weakness, which the Fed will likely set up in pursuit of inflation. Secondly, we implemented an allocation to the US energy sector. Amid the COVID-19 pandemic, the energy sector drastically underperformed as the global economy was ground to a halt. With the advent of the vaccine rollouts, this sector has also rebounded most sharply as markets are beginning to anticipate an eventual return to normalcy. For context, even though the energy sector was up 34% during November and December, the sector remains 36% off its closing price at the end of 2019. The next lowest US sector performance is financials, which was down nearly 4% in 2020. Therefore, our model is indicating that US energy, a cyclical sector closely tied to the health of the domestic and global economy, has started an upward trajectory and presents a strong investment opportunity, as well as an above-average dividend yield. These two positions were funded from our US large-cap growth exposure, which we continue to emphasize. It was also interesting to observe several significant developments within the private markets. Their transactions seemed to restart in the fourth quarter, of which several of our managers took advantage. Fulcrum, our growth equity manager, exited its investment in Fat Merchant, a payment processing company out of Orlando. The 4.8 times gross cash-on-cash return represents an early and sizable win for Fund 3, which is a 2016 vintage fund. Our US real estate manager, Harvard, also saw deal flow pick up as it exited the Palmer Apartments, a multifamily asset located in Woodstock, Georgia. The Palmer investment generated a 38.3% IRR and a 2.56 times equity multiple to Harvard's 6 over a 36-month hold period. Both Fulcrum and Harvard are currently fundraising for their next funds. Peachtree Hotel Group, to which we have been recommending an allocation to take advantage of the significant dislocation and distress in certain pockets of the hotel industry, has also been active towards the end of last year and is also still open to new commitments. Our latest fund recommendation, which is also currently open, is a senior secured debt fund managed by Monroe Capital out of Chicago. We were pleased to be able to negotiate a lower fee for clients accessing the Monroe Fund by leveraging Ballantyne's economies of scale. An allocation, as a reminder, to Monroe helps to boost yield significantly across our strategies. Finally, our private equity buyout manager, J.F. Lehman, was also active during the fourth quarter, taking the opportunity to buy two companies in its area of focus, that being aerospace, defense, maritime, and environmental services sectors. Intact, an environmental remediation and geotechnical construction service company headquartered in Illinois with offices across the US, and it also purchased CTS Engines, a maintenance, repair, and overall service company for mature aircraft engines located in Florida. We are excited about the progress our private capital managers are making in an environment in which their discipline positions them to be highly selective and to provide patient, active management beyond the point of commitment. As always, your relationship manager will have more information on these funds and the opportunity that they present to you. Let me end off this morning's discussion with some comments about history not repeating itself, but often rhyming. You know, a century ago, The year 1921 heralded the dawn of a decade of economic growth and widespread prosperity, which later became known as the Roaring Twenties, driven by recovery from the devastation of the First World War, as well as a global health pandemic, the Spanish flu. Construction and deferred spending were boosted and sustained by the productivity gains derived from the widespread adoption of new technologies, such as the automobile, electricity, radio, and television. Some sectors, such as farming, stagnated, while others in manufacturing boomed to drive the United States to become the richest country in the world. The festivity ended on Black Tuesday, October the 29th, when the Dow Jones Index collapsed after months of frenzied speculation. The Wall Street crash became a key cause of the Great Depression in the 1930s. Isn't it remarkable how 2021's investment themes outline many of the influences driving the economy in 1921 beyond the obvious comparison to the Spanish flu and coronavirus pandemics? Whereas back then it was construction and deferred spending from a war which drove prosperity, today it may be the infrastructure spending and pent-up demand for services which may catalyze robust economic growth. In 1921, automobiles and electricity powered productivity gains. Today it is technological innovation in communication and automation. The comparison between the 1920s and 2020s also brings one important reminder to investors. It is ultimately higher inflation and interest rates and euphoric speculative excess that bring an end to a period of expansion and high returns, which is why our discipline, as I mentioned earlier, is so focused on measuring how expensive stocks are relative to interest rates. And that will ultimately allow us to reduce exposure to risk assets in advance of major equity bear markets, to build up dry powder to take advantage of lower prices. We currently do not see relative value extremes nor signs of abundant speculative excess that typically characterize a major market top. Over the longer run, we have just published our annual capital markets forecast, which is also available on our website at ballantine.com. As usual, it looks beyond the current year to evaluate the ranges of expected outcomes that are realistically possible from today's starting point over the next market cycle across a range of asset classes. We use these inputs regarding expected returns, risk, and liquidity constraints to design the foundation of our strategies in order to maximize the probability of our clients hitting their goals over time. This year's edition is called The Economy and Capital Markets in a Changed World, and addresses central longer-run challenges and opportunities for investors in the coming years, such as, with risk-free interest rates at rock-bottom levels, into which other asset classes should diversification occur to provide reliable capital preservation in times of duress? How to boost income from a strategy in a reliable and sustainable way without taking undue credit risk? What is the risk to capital growth from today's elevated valuation levels? How does the opportunity to allocate to private markets increase the probability of success, and what are the unique risks involved in doing so? If any or all of those questions are on top of your mind, I encourage you to spend a little bit of time with our annual capital markets forecast. So to summarize, 2020 was one of the most disruptive years in generations. The experience and discipline of navigating several previous market cycles helped us perform well from an investment standpoint on behalf of our clients. Though the coming years may not perfectly resemble the roaring 20s of strong economic growth and abundant prosperity from a century ago, there are reasons to remain optimistic about the near-term investment outlook while staying very mindful and realistic about longer-run risks and challenges. And now I would like to hand it over to Gabe Lembeck, our Director of Investment Research, who will provide a little bit more detail around capital market movements over the fourth quarter.
Thank you, Adrian. The fourth quarter provided a final boost to what ended up being a tremendous year for the markets. Equity indices across the board were up double digits during the quarter. which is an amazing feat given the year opened with the worst first quarter in history. If we look by building block, starting with our liquid building block, rates remain near zero and are projected to stay there on the Federal Reserve's commitment to keep rates low, at least for another couple of years. Recall that our goal for this building block is merely to ensure sufficient liquidity to meet spending needs without having to impair capital from other building blocks in the case that spending needs crop up while the market is temporarily down. So while we expect cash rates to remain effectively zero for the near future, that will not impact our allocation to this building block, which is less about garnering return and more about strategic cash management. Fixed income had another solid quarter, as bonds continued their gains in the fourth quarter, with municipals returning 1.8% and corporates returning 0.7%. Meanwhile, Treasury inflation protected securities, or TIPS, rose 1.6%. This brings year-to-date gains for each to 5.2%, 7.5%, and 11% respectively, a tremendous year for fixed income. In our largest building block, market risk, equities had one of their strongest quarters in years, fueled by the very strong end to the year in November and December. The S&P index added 12.1% for the quarter, bringing the year-to-date gain to 19.4%. Domestic markets were up 12.1% and trailed international developed during the quarter, which were up 16.1%, trailing them for the first time as international markets benefited from beaten down stocks rebounding on vaccine optimism. Emerging markets posted a strong quarter, going from a loss to a gain, plus 19.8% for the quarter, resulting in an 18.7% gain for the year. From a style perspective, value led growth for the first time this year, but growth maintained its historic outperformance for the year. Small cap equities rallied furiously out of the red with a return of 31.4% for the quarter to finish the year up 20%, versus large cap up 13.7% for the quarter and up 21% for the full year 2020. Gold was flat for the quarter at negative 4.4%, but it posted a solid year-to-date return of 20.9%. While yields remained relatively low to end the year, with the 10-year Treasury ending the year around 1%, risk-free yields did show a notable rise to end of the year, as denoted by the gray line in this chart. This stemmed from optimism about a recovery from the COVID economic full stop experienced earlier in the year. Yields on securities with credit risk, as denoted in this chart by the orange line, stayed relatively flat, as the increase in the risk-free rate was offset by the narrowing of credit spreads, as credit concerns associated with COVID slowly abated throughout the year. We expect short-term rates to remain lower for longer. Recent comments by Federal Reserve Chairman Jay Powell and other Fed officials indicate the Fed Open Market Committee will maintain its ultra-low rate range through at least 2023 in order to facilitate a healthy U.S. economic recovery from the fallout of the coronavirus pandemic. Market expectations have aligned with that probability. When we look at our most important model relationship within equities, U.S. large cap growth versus value, we experienced a huge discrepancy during 2020, with growth up 38.5% for the year, trouncing value, which was up only 2.8%. That said, value posted a strong rebound during the quarter, and although our models continue to favor growth, they do so to a lesser degree than a few months ago. We continue to monitor the relationship closely for when our model indicates a more definitive cyclical switch to value has surfaced. In addition to our emphasis of growth over value, we continue to favor domestic over international in general. We believe emerging markets have turned a corner, and we took a position in the fourth quarter. However, in contrast to emerging markets, international developed markets continue to lag the US, though they have performed better of late. Overall, strong breadth across the board gives us greater confidence in the sustainable of equity market strength. And despite the strong run-up in equity prices we saw during the year, specifically during the fourth quarter, we see few signs the bull market has exhausted itself. In fact, looking at a list of 9 common indicators, we find only one that is showing signs of being in late innings, namely the amount of IPO activity. All other indicators continue to show signs of being well away from being at a cyclical peak. In our private capital offering, the following funds are still open to qualified investors. The AMG Pantheon Fund with a minimum of $25,000. This is an evergreen 40 Act vehicle which invests primarily in co-investment opportunities drawn from Pantheon's global platform. Fulcrum Fund 4 with a $250,000 minimum. The fund focuses on Southeast-based healthcare and technology companies with $3 to $50 billion in revenue. Harbert's Fund 7, also a $250,000 minimum, is a diversified private real estate fund focused on primary markets with strong job growth, diversified economies, and depth of institutional ownership. Its sector focus is on Class A and Class B office, multifamily, retail, and industrial properties. The Monroe Private Credit Fund 4, also at $250,000 minimum. This fund's mandate is to originate senior secured loans directly to companies and private equity sponsors. Monroe is a Chicago-based firm founded in 2004 that brings a credit-first, zero-loss mentality to investing. These loans are high cash-flowing securities with low loss rates, which make them a timely investment given low interest rates. And lastly, the Peachtree Distressed Opportunity Fund with a $100,000 minimum. This fund is managed by the Peachtree Hotel Group with a mandate to invest in distressed hotel opportunities across the U.S. This fund gives clients the opportunity to target stressed pockets, of which hotels is a major component. It is important to take note of the performance in asset classes over the last decade and compare that with what we are projecting in our capital markets forecast. As is often the case, the leaders of the recent past do not end up as the leaders going forward, as funds flow from the winners to the recent laggards. So strategically, we expect the recent U.S. dominance not to be the case going forward. Simply stated, based on present asset prices and growth forecasts, we do not believe the past decade's sources of returns are likely to be those that power forward during the coming decade. But as we have said multiple times in the past, the path and timing of the returns is uncertain. Looking ahead at some of the challenges and opportunities. With risk-free interest rates at rock bottom levels, into which other asset classes should diversification occur to provide reliable capital preservation in times of duress? How to boost income from a strategy in a reliable and sustainable way without taking undue credit risk? What is the risk to capital growth from today's elevated valuation levels? How does the opportunity to allocate to private markets increase the probability of success? And what are the unique risks involved in doing so? At this point, I will turn things back over to Adrian. Adrian, back over to you.
Thank you very much, Gabe. And thank you to you all for your time and attention in listening to our discussion. We are very grateful for the trust and confidence you place in our team and process. Thank you very much. Please do not hesitate to call if we can answer any question you may have.